While most people sleep, the silver market keeps getting hit by strange midnight attacks that make no sense in a normal market. Prices crash in the quiet hours, huge sell orders appear from nowhere, and the data shows patterns that look less like trading and more like a trap. These same signals, sudden fractures, odd timing, heavy paper selling, have shown up before every major break in gold and silver history. Now they're back, right as silver is being pushed away from its path toward $100, and it's happening into the low-volume Christmas period when almost nobody's watching. If this is just random, the numbers shouldn't line up, but they do. And when you follow the trail, the Christmas trap around silver starts to look very real. So if you want to understand who might be doing this, how they're doing it, and what it could mean for your money, watch this story all the way through. And don't forget to subscribe, like this video, and share it to support the channel. The first clear signal appears when most people are asleep. Again and again, the strongest drops in silver do not happen during busy New York hours. They happen between roughly 1 a.m. and 4 a.m. Eastern Time when trading is thin, screens are dark, and just a few large orders can move the whole market. Price falls of 50 to 70 cents in a few minutes are common in these windows, even when no major news hits the wire. That timing is the first red flag. In normal markets, big moves line up with big headlines or clear data. Here, the pattern is flipped. Quiet news, quiet volume, violent price. It looks less like many small traders changing their minds, and more like one heavy boot stepping on a weak floor. A similar setup showed up in April 2013 when gold was knocked down in a 2-day crash driven by huge sell orders dumped into thin trading. Years earlier, during the London gold pool in the 1960s, official sales often came when London and New York trading could be used together to lean on price with the least pushback. One strange detail stands out today. These midnight smashes often start with a single large futures order, big enough to push price through several support levels at once. The move then triggers automatic selling by algorithms, like a small rock kicking off an avalanche. The open question is simple. Who chooses to attack only when the market is weakest, and why now when pressure for much higher silver prices keeps building? Silver today looks like a pressure cooker with the lid bolted down. On the cost side, mining is getting harder, not easier. Many silver mines report all-in costs that sit close to, or even above, today's market price. Energy, labor, and equipment are more expensive, and a lot of silver only comes as a byproduct from mining other metals. That means supply cannot quickly rise just because price should be higher. At the same time, demand keeps growing. Solar panels, electric cars, electronics, and even medical uses all need silver, and they need it in a very pure form. Industry does not easily thrift this metal away. Reports from groups like the Silver Institute have shown repeated yearly deficits, where demand is larger than mine supply plus recycling. Under normal conditions, a market with ongoing deficits should rise strongly. Here's the anomaly. Instead of moving toward $100, spot silver spends long periods stuck, then gets hit with sudden drops. Like the midnight smashes we saw earlier, it is like watching a spring being pushed down harder each month while the official gauge claims nothing to see here. History shows how this usually ends. In the 1970s, after years of rising inflation and tight supply, silver broke out from low single digits to near $50 in a short, wild burst. The catch-up move wiped out anyone who had trusted that low prices meant low risk. The open question now is how long paper selling and odd-hour attacks can delay the next break, and whether this holiday season is being used to hold that lid down one more time. Around Christmas, the silver market quietly changes shape. Trading desks are half empty. Many fund managers are on vacation. Volume drops, and price often moves on very small trades. This is normal holiday behavior, but it also opens a door. A few large players can move the price much more easily than in the middle of the year. Dealers know this. So do big banks and fast trading funds. They can see year-end positions, options levels, and margin calls like a map. If silver is close to a key price level, a push below that line in thin trading can force weak hands to sell. It is like kicking the leg of a wobbly chair when no one is ready to catch the person sitting on it. The odd thing is how often sharp drops in silver cluster around late December. In several years, prices were hit hard just after Christmas, even when wider markets were calm. In 2011 and 2015, for example, gold and silver saw sudden year-end slams, followed by fast rebounds once full trading returned in January. The timing is the irregular signal. History offers another clue. In the late 1960s, officials in the London gold pool often used quiet periods to dump metal and guide the price lower. The goal was to send a message. Gold is under control. Today, paper-silver sell-offs into thin holiday markets send a similar signal. The open question is simple but serious. Is this Christmas set up as just another short-term trap, or the last big push before control finally slips? If it fails, the move toward 100 silver could speed up instead. To see how the midnight attacks work, you have to look at the paper world of silver, not the real metal. Most global pricing is set on futures markets like COMEX in New York. On these screens, contracts trade that promise silver in the future, but almost nobody takes delivery. The game is mostly paper against paper. On many days, the number of paper ounces traded is more than 100 times the amount of silver that could be delivered from COMEX vaults. That is the first clear warning sign. It is like a coat check that prints 100 tickets for every one coat in the room. As long as only a few people ask for their coats, the trick holds. If many ask at once, the lie is exposed. Data from the CFTC, the U.S. futures regulator, shows another pattern. A small group of big banks hold a very large share of the short positions in silver. They have often leaned against rising prices, selling into rallies and then buying back after sharp drops. This behavior fits too neatly with the sudden dumps during thin trading hours. There is also a history of proven cheating. In 2020, JP Morgan paid a huge fine after U.S. authorities found years of spoofing in gold and silver futures, placing big fake orders to move price, then canceling them. That case confirmed that manipulation was not a theory, it was business practice. The open question is how deep this goes today. If even a small wave of traders demand real metal instead of rolling paper, can the same banks still control the price, or does the system start to crack? In the end, paper claims do not power a factory or fill a solar panel. Real metal does. To judge how healthy the silver market is, we have to watch where the bars actually move. In recent years, quiet but steady outflows from major vaults have started to look like cracks in a wall. Comex reports split silver into different groups. One key group is registered, meaning metal ready for delivery against futures. Since 2020, that pile has gone through long periods of decline, even while the paper price stayed weak. London vaults tied to the LBMA have also reported falling stocks. It is like walking into a store that keeps shrinking its backroom supply while insisting there is no shortage. At the same time, many silver ETFs have seen large withdrawals. Big holders are taking shares, turning them into real bars, and moving them out of the system. Yet retail buyers face delays, and coins often sell at high premiums above the so-called spot price. That gap is the anomaly. The street price acts tight, while the screen price acts calm. History has shown this movie before. In 1968, the London gold pool collapsed after too much physical gold left official vaults at an artificial low price. In 1979, U.S. coin shops ran out of silver as the price finally exploded higher. Low price plus strong physical drain was the warning both times. Today's open question is simple. How long can midnight paper attacks keep silver cheap while real metal quietly walks out the door? At some point, a futures market that promises more metal than it can deliver risks a sudden break in trust, and that break often happens fast. When a market is healthy, its signals line up. Futures prices, real-world premiums, and daily swings all tell roughly the same story. In silver, those signals are starting to clash. Look first at the futures curve. Normally, contracts for delivery later in time cost a bit more to reflect storage and interest. Many times in recent years, silver has slipped into backwardation, where near-term prices rise above later ones. In simple terms, the market sometimes says, I want silver now more than I want it next year. That is rare for a monetary metal, and it is a quiet alarm bell. It is like seeing a crowd gather at the door while the official sign still says, no rush. At the same time, retail buyers often face high premiums on coins and small bars, even when the comex price is flat or falling. A 1-ounce coin might cost several dollars above spot. That gap is the anomaly. The screen says one thing, the shop counter says another. It is like a map showing clear roads while drivers sit in a traffic jam. Volatility is sending its own mixed message. For long stretches, silver drifts in a tight range, then suddenly explodes in 1 or 2 violent days, usually down during thin trading. This pattern rhymes with past periods of control, such as the years before gold broke higher in the 2000s. Calm on the surface, sharp jolts when stress leaks through. All these fractures connect back to the same story. Midnight attacks, heavy paper shorting, and a market trying to hide growing tension. The open question is, how many more hostile signals can appear before traders stop trusting the posted price altogether? The trail now points to a coming breaking point, not just another dip. For years, large players have used paper futures, midnight attacks, and holiday traps to lean on silver. Yet the base facts keep moving the other way. Mine costs are rising, industrial demand growing, and real metal leaving vaults. It is like pulling a rope tighter and tighter. The rope looks still, but the hidden strain is rising. History shows what happens when control finally slips. In 1979, silver went from a calm market to a near vertical spike toward $50 once faith in the old price broke. In 1968, the London gold pool fell apart almost overnight when too much gold was demanded at a price that was clearly fake. Years of quiet pressure ended in a sudden repricing. The red flags today line up in a similar way. Repeated backwardation, high retail premiums, thin registered stocks on comex, and heavily concentrated bank short positions. Add a low liquidity holiday period and one more violent midnight smash could easily trigger the opposite of what is intended. Instead of scaring buyers away, it could spark a rush for real metal and force short sellers to cover. Picture a final push on a cracked dam. Most days, the wall holds. Then one extra shove sends water pouring through the weakest point. In silver, that weak point is the gap between huge paper promises and limited physical supply. The open question is no longer whether silver will be repriced, but how orderly that move will be, and whether the next Christmas season attack becomes the spark that launches the run toward $100 and beyond.